Welcome back to the Lateral Lawyers podcast. I'm your host, Shane Rody, and I'm going to be just working through a few explanations about the difference between two very common forms of business sale and purchases. That is asset sale and purchase and a share sale and purchase. An asset sale and purchase, which is the most common form. My levels there are a little bit loud. It's been a while on the tools. So an asset sale and purchase, usually governed by the Auckland District Law Society standard for smaller businesses. I'm talking about Auckland District Law Society standard sale and purchase agreement. It deals with the sale and purchase of course, assets. So when you buy a business, you purchase all of the listed assets on the sale and purchase agreement, and that includes both tangible and intangible assets. So tangible assets are things like furniture, computers, if it's a small services business such as an accountancy or a law firm, and any other tangible fixed, what they call them, asset that you're able to purchase in conjunction with the business. Oftentimes with a smaller business, the tangible asset value can be minimal. Of course, with more capital intensive businesses such as a trucking company, their fixed assets or the tangible assets will be of significant value. As a purchaser, of course, you want to have a high proportion of the purchase price constituted by the tangible assets, because you will be able to depreciate those during the life cycle of the business. And as a vendor, of course, you would want a lower apportionment of the purchase price directed towards the tangible assets. Otherwise, you're probably going to have a tax issue with your accountant post-settlement. Intangible assets includes most regularly or most frequently things like, for example, under a franchise, the goodwill associated with the brand that you have a license for under a franchise agreement, intellectual property, and the goodwill in the business, including the goodwill under the lease for any kind of business that has premises such as a hospitality business, and is usually with smaller business sale and purchases constitutes the lion's share of the purchase price. That's the intangible assets under the sale and purchase agreement. So with intangible assets, there are a few little nooks and crannies where issues can hide. For example, when you buy a franchise, if there is significant value attributed to the franchise agreement and the value over that a franchise agreement has, of course, a fixed life cycle, such as 5 years or 3 by 3 years, you are actually able to depreciate that the same way that you would depreciate a tangible asset under the Income Tax Act. You'd need to go and see your accountant about that, and you'd need a provision in the IRD requires a provision in the sale and purchase agreement, which actually shows clearly that the parties had turned their mind to the fact that there was what under the Income Tax Act 2007 is described as intangible depreciable property, or it may be depreciable intangible property. Not sure on the exactities of that, but that is an important consideration. That's why you come and see us, and we will direct you to a great accountant like Luke Kemis down at Next Advisory and Phil Smith. They will be across all of those things. The devil is in the detail. So that is an asset sale and purchase. Then you have, of course, a share sale and purchase. Now, a share sale and purchase, as distinct from an asset sale and purchase, where you purchase only the assets and not the liabilities of the business. A share sale and purchase, you purchase shares in the company that owns the business. So once you own those shares, you will own, of course, not only the assets, and you'll also assume all the liabilities. You'll assume all the contractual arrangements of the company. Be careful, of course, to check that you meet any change of control provisions in documents such as leases or supply contracts or customer contracts. And with a share purchase, you, of course, assume all the employment obligations of the vendor company as well. So that is the broad distinction between an asset sale and purchase and a share sale and purchase. Both have strengths and weaknesses, pluses and minuses, and you need advice from somebody like ourselves in the specific circumstances to determine what is the best structure for you to purchase the business, as in popular terms, the business. So yeah, if you're in a position where you're looking at buying a business, usually you would, particularly with a smaller, less complex, say anything under $2 million business, usually you would be looking to just acquire the assets of the vendor. Gives you, of course, the advantage of being able to cherry pick out which assets you want and which assets you don't want, and you don't have to take on any legacy problems, including, of course, significant tax problems of the vendor company. It's also cheaper and much simpler from a legal perspective because your lawyers won't need to take scrutinize quite as much the operation of the vendor company, given that you will only be taking over those assets which you perceive to be of value. If you use us to purchase shares in a company, particularly if it is shares for significant value, and we, it's a business that requires significant, scrutiny and looking under the bonnet, the amount of time it takes us to go through and to work through all of the due diligence requirements in respect of a company trading as I'll start again. The amount of time it takes us in terms of due diligence to actually work through all of the different risk areas for a share purchase is significant, and the negotiation in terms of vendor warranties and assurances, and in some cases earn-out provisions, funds held on escrow, is far more significant and drawn out. So it's usual that share acquisitions are far less frequent, and there is usually a reason why, often from an accounting perspective or from an employment perspective, if it's a much larger company, or some peculiarity to do with the ability to assign a contract, that a purchaser will be advised by both us and the accountant working in tandem to complete the transaction as a share purchase as opposed to an asset purchase. But that's not the normal situation or the status quo, and it is usually makes more sense in terms of pros and cons to complete the transaction as an asset sale and purchase. All right, guys, thank you very much. Great to be back on the show and trying to provide a little bit of value as I'm trying to get my outro music going on my fancy new podcasting software, which I look forward to some gaps in my schedule. Haven't had any recently, but look forward to doing these because we get a huge amount of enjoyment out of doing it. And a lot of people messaging us and, new clients, which is great for a little business like ours. And hope you have a great rest of your day. And I look forward to seeing you online again very shortly. Cheers.